under the heading of capital on stage, because this is a reverse pitch thing where you're getting pitched by all these investors, I figured we would reverse it around and tell you the secret stuff that we angel investors know that would be very useful for you guys to know as entrepreneurs. Recently, some of you may know that I wrote a book. Shameless plug for a book. This is Angel Investing, the Gus Guide to Making Money and Having Fun Investing in Startups. And unlike every other book you've read about startups, which is designed for you guys to get money, how to raise from your friends and family, how to start a business, this is the secret instruction book for angel investors. So this was written specifically to tell all the people who are on stage here how they can actually be a good and smart angel investor. So I actually wrote a couple of these, and I haven't decided whether these should go to the VCs that you voted, the most useful VCs at the end of the day, or whether we should turn around and give it to the most interesting companies. But in any event, I'll let them decide. So the goal for today, in the 10 minutes, 15 minutes that I've got, is to tell you how angel investors look at what's going on. And so the first case is, what is an angel investor? How do angels differ from VCs? For many people, angels and VCs are one word. It's like, oh yeah, I'm going to go out and raise money from angels and VCs, or VCs and angels. But in reality, they are two completely different things. VCs, as you know, are professional money managers. All these guys who are pitching you, except for Sharon, who is a different kettle of fish, but all the VCs who are pitching you are professional money managers who get paid to manage other people's money. Angels, by contrast, are individuals, what I call rich-ish people, not really, really rich people, but they're accredited investors, because the law says that in order to invest in private companies without a whole public offering on the public stock markets, you have to be an accredited investor, and that means having either $1 million in net investable assets, not including the value of your primary residence, or at least $200,000 a year in income, or $300,000 if you file jointly with your spouse. So anybody who hits that level is probably in the 1%, 2%, 3%, so they are rich. But on the other hand, if you're Bill Gates or Mike Bloomberg and you've got 10, 20, 30, 40, 50 billion, you just don't have the time to go around and put it out in $25,000 increments to all these wonderful companies in the room. So therefore, the really rich guys don't do angel investing. It's only people who have enough cash to not play with, but try and get some additional return on it. So why do they do angel deals? Because angel investing falls into a category of investments called alternative assets, alternative investments. And so if anybody is smart, the bulk of people's investable capital is going to be into mainstream things like stocks and bonds. You'll take some of it in very conservative things like T-bills, and some of it in more risky things that have a higher return. And if you figure that the stock market over time has averaged plus or minus 5% as a return, that's not too bad, but it barely keeps pace with inflation, and you want to try and do some more. But to get a bigger return, you require more risk. And if you risk it, you can lose it. And so therefore, typically, investors, both the institutional investors who invest into the venture funds, as well as angel investors, take a small part of their portfolios, figure 10% plus or minus, and put it into this whole category of things known as alternative assets, which includes anything other than stocks, bonds, and T-bills. So effectively, you're looking at oil and gas, you're looking at real estate, you're looking at hedge funds and venture capital. And if you happen to be one of these people who has a hankering to support the early stage entrepreneurial world, you can get to be an angel investor. And so angels take money out of their own pockets and put it into early stage companies like you guys. Now, the challenge with investing in early stage companies is it's really risky. If you happen to hit a couple of those really nice big home runs, like Uber going from $0 to $17 billion in less than 5 years, good deal out there, you do very, very well. I haven't hit Uber yet, unfortunately, but I'm keeping on trying. It turns out, however, that if traditional angels, when I say traditional, it means people who've been doing this for a while, but not particularly seriously. They would see one of you guys at a cocktail party over drinks here, or actually this is a pretty sophisticated group, so not in this context, but say at the country club or Norwood House or walking down the street, and you say you're in an elevator with them, you give them your elevator pitch, they say, oh, well, that sounds really cool. Yeah, it's going to take over the whole world. Cool, I'll invest. Here's some cash. Right. Doesn't happen quite as often as you would like, but it sort of does happen. And historically, that's the way these angel investments got made, which is, oh, I see a nice, bright, shiny thing, and so I'll give you some cash, and it's a gamble, and who the hell knows what's going to happen. But it turns out that starting about 10, 15 years ago, after the dot-com boom and bust and the nuclear winter, angels began to get a little more organized and began to realize that if you do this rationally and with discipline, the antithesis of being an entrepreneur and a sort of wild and crazy startup person, you actually can repeatably make money. But the trick with doing this is you make money as an angel on the long haul. It's a long period of time, it requires discipline, and it requires a diversified portfolio. Because I hate to break it to you, but as wonderful as everybody sitting in this room is, the statistics show that half of you are going to fail. And unlike a public company that doesn't quite live up to its earnings or has a drop over time, when we say fail for the kind of companies in this room, that means fail. That means gone, dead. And so if you go, say, hey, honey, I put our pension and our long-term kids retirement fund in this company, and the company's gone, so the money is gone, that doesn't quite work. So if you're talking about the fact where half of the investments we make are going to fail, the only way that we can make this work on the long haul is to have enough winners, enough companies that are really successful, and the other half to make this actually work. So how do you do that? Well, it turns out that if you look at the metrics over multiple portfolios, long periods of time for angel investors, typically, and the angels are even more risky than the VCs who are investing, as you heard, later stage, so they have fewer failures. In the angel world, we have found typically that of 10 deals that we're going to invest in, half of them are going to go bloop, disappear literally with every penny that we put in, and they're out. Of the remaining 5, which are not dead, 2 of them are likely to return even money. And that means that at the end of 5 or 6 or 7 years out there, somehow somebody will take the body off the street, as we call it in behind-the-scenes parlance, and it'll be either an acqui-hire, or you'll sell the furniture, or somebody will buy the code, or something or other, and we'll just get back the dollars we put in. But if you recall the time value of money, that doesn't do much for my returns. Well, luckily, you got 3 more left, and of those 3 more left, 2 of them are going to be solid winners, and they're going to return 2 or 3 times the investment that we put in the company. And that would be great. So if we could reliably get 200 to 300% on our investment over that period of time, over the whole portfolio, we'd be very happy campers. The only problem is, as you recall, half my portfolio just wiped out. Right? So if you do the math, I'm now, out of my 10 companies, I got 9 of them accounted for. 5 failed, 2 even money, and 2 returning, say, a 3x. And now, if you look at the average holding period for an angel investor, we'd like to say, the average holding period is 5 or 6 years. In reality, the statistics show for a U.S. angel investor, it's 9 years. But if we were to actually figure things on the basis of having a holder for nearly a decade, we would all go screaming out into the night and wouldn't invest in anything. So we all self-delusionally tell ourselves it's really only 5 or 6 years. So modeling it at 5 or 6 years and looking at what kind of return we should get. Well, let's stop right there. What kind of return do you think is appropriate and fair for an angel investor? Remember, we're putting money in, it's being locked up for nearly a decade. We're giving you our connections and our network, we're helping to advise and mentor you, and we know that this stuff is going to be very, very risky. So if you put money into the stock market, maybe you get 5%. If you put money into a hedge fund, I think Bernie Madoff, you can get 10%, although maybe not quite the way he did it. If you put it into private equity, you can maybe get 15 if you get a really good PE fund. You put it into a venture fund, like the guys who are pitching here. They're really coming out here and plowing in this fertile ground for these big home runs. So they all mostly will target 20% cash. How many get them is another story, but that's their story, and they're sticking to it. So therefore, if in theory I can put money into guys like Danny and so on and get 20%, then what do you think I should be able to get, or what's the appropriate return for me as an angel investor if I'm doing all this finding deals and investing and mentoring? What do you think? What's a fair return? What would you be comfortable as an entrepreneur saying my return should fairly be for all the work I'm putting in and doing this, putting in my personal cash? 45. Annual return, annual IRR, dollars to dollars. I can put it in stock market, put it in venture fund, put it in PE, put it in whatever, or now I'm going to put it in angel investments. What should my return be? 45% we heard? Any other bids? 15%? 15? Yeah, well, that's great. 15%, I should put 15%, I can put it in a hedge fund, and why the hell am I going to be spending all my time looking at deals and writing term sheets and doing all this stuff, mentoring things? That's not going to work. If you do it at 15%, what? No, on your company. So on my portfolio. So if I'm putting it in the category of angel investing, right? So if I can get 5% pretty straightforward by throwing it into an index fund in the stock market. And if I put it in something like a hedge fund, I got a decent chance at getting 10%. And private equity, if I have access to a decent fund, 15%, and the VCs go hopefully 20%. So if I can get those numbers with no work as a passive investor, assuming I have access to getting into these good funds and stuff, I should, in theory, the logic says, if I'm doing all this work, and believe me, being an angel is really a lot of work, if you do it right and you do it seriously, I should get compensated above that. The question we're asking is, how much above that should I get compensated? And I heard a bit of 45. Got anything else? What? Same as oh, so payment endpoint. So the bottom line is, let's see. I should get 20% here, or I can get 20% by giving it to him. So therefore, well, clearly I'm going to give it to him, and I'll go out and sit on my yacht, right? So first I got to get a yacht, but then so it turns out that the statistics show that for a professionally managed angel portfolio, doing this seriously, the way we talk about in the book, the way most of these angel groups do, over a long period of time, over the whole portfolio, the average return is 25% IRR. Okay? And so that's, now some might say, oh, 45% sounds a lot better if I'm doing all this work and it's tied up for so long and I can't feel liquid and blah, 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 blah. My wife's going to kill me when the company tanks that I told her was such a great company. But the bottom line is 25% is where it is. So now back to my math. If we now are aiming for 25% IRR, which I don't think anybody would say is too much to get my angel portfolio, but I've already accounted for 9 out of my 10 companies. And 9 out of those 10 companies, if you account for the time value of money, because I remember I got 2 times 1 and 2 times 0.3. So that means with the time value of money taken into account and factoring in that 25% IRR, I'm now back to 0. So I've got through my entire portfolio and I'm back to exactly where I started, which means that my return, my 25% IRR over time on my whole portfolio has to come from your one company. So your one deal, that 1 out of 10, that's going to be my home run, if you do the math. We don't have time to do a chalkboard stuff over here, but if you do the math, trust me, it works out to 30x. I have to get 30 times my investment back in 6 years on your one company to make my portfolio come out at a 25% IRR over time. And that factor tells you several different things. It accounts for, one, why the vast majority of people who call themselves angel investors lose money instead of make money, and why those investors who actually can reasonably get that 25% over time make money by being very rational in terms of the valuations. So if you say, oh, these evil, nasty angels, they're telling me that I'm only worth, $3 million on the West Coast, and Andreessen Horowitz is putting money in at a $15 million pre for somebody who had nothing over here, so why can't I get that money? Well, it turns out that if you actually look at the numbers, let's do the numbers this way. If I got to get 30x, trust me on that one, then if you are saying, okay, my company, I put in $1 million to your company and I get 10% of your company, right? So what am I saying? What are we both agreeing then that your company is worth when you walk in my door? If I get 10% of the company for $1 million, what are we saying your company is worth? There you go. We got some good people in math here. Right. Smart. 9 million, right? Because your 9 million pre-money valuation plus the million I put in means 10 million post-money valuation. I get 10%. So you're now at $10 million. So therefore, for me to get a 30x on my investment, which is only 10% of what you sell for, you have to sell the company for $300 million. So your company that I'm investing as a seed stage angel right now has to sell for $300 million. And I will tell you that I've invested in over 100 companies in my career as an angel. I've had exits to Google, Facebook, Amazon, Intel, CBS, host of players out there. Haven't hit one $300 million company yet, despite investing in the best entrepreneurs I can find. But now let's take another story. Let's say that I'm investing $100,000 and a $900,000 pre-money valuation. So now we have a $1 million post valuation, and 30 times $1 million is 30 million. And guess what the sweet spot for M&A deals for early stage startups is? It happens to be between $20 and $40 million. So therefore, that makes sense. So therefore, if I am an angel investor looking rationally at investing in a deal, I have to look at the potential for an outcome. I have to look at who your potential acquirers are over time, what value are you going to create in the company. And if I can see, if I can see how to get to $300 million, that's great. Maybe you'll get a $10 million post. But in reality, the average valuation, the average pre-money valuation for a pre-revenue startup in the US funded by angels is $2.1 million. So, so one of the differences between New York and California investors is California works in a very sort of strange world. The blogosphere, people are looking at this as a total binary thing. It's either going to be Uber or we're going to go home. And therefore their thinking goes, well, if I'm investing in Uber, it doesn't matter if I invested $1 million, $10 million, $100 million, $1 billion valuation, I'll still, thank you very much, do very well. So I just have to be in Uber. And they sort of, it's all risk it on one turn and pitch and toss, as the poet says. In New York, we tend to be much more rational, and we say, okay, you know what, most of us haven't hit Uber yet. On the other hand, we've all seen lots of deals that are acquired at 20, 30, 40, 50, 60, $70 million. And that's great. But if you do that, to make money on it, you have to have rational valuations. So that's how angels calculate these things about the early stage valuations. And then I'll tell you something else, one last thing, and then I'll take a couple of questions, and we can get back to hearing the VC's pitch. And that is, who knows what the J-curve is? Anybody here heard the J-curve? The J-curve is well known to VCs and is increasingly well known to angels who actually think about this kind of stuff. And that says that the value of your portfolio makes it shaped like the letter J. So when I put money into your company, what happens? Well, let's see, you're a pre-profitable company, not making any money, and you're getting my money to actually pay salary and stuff, so the value of my portfolio is dropping the minute I put my money in. And then it turns out the companies that are going to not succeed tend to die early. And so the companies that are going to fail quickly. And so therefore, the first company fails, second company fails, third company fails. So the value of my portfolio, starting here, the minute I invest, starts dropping like this. And it's only after a few years, after the companies that have died, that are going to die, have died, and the bigger companies that are going to be these bigger successes take a longer time to get to be a really big success, take their hockey stick and go up. So therefore, for VCs and for angels, the J-curve says you start here, it goes down over time, and then some number of years in the future, 2, 3, 4, 5, 6, 7, 8, depending on how long you're holding, it begins to rise. And only then at the end of the day, and this could be 6, 7, 8, 9 years out, does your value of your portfolio get to be higher than where it was when you invested. And so that's why it's a long-term hold, because the good things happen later. So with that, I will stop and I will take questions. Go ahead.
Frank, what are some of the criteria a typical angel will use to value a zero revenue business anywhere between 3 million and 10 million?
Yep, so the answer is, the question is, what criteria would an angel use and how do you do evaluation? The answer is there's a whole chapter in the book, so get the book. It's available at wherever fine books are sold, at Barnes & Noble, Amazon, available Kindle, and even an audio version, and there's even a free version, a free iPhone app for you. But the bottom line is it's a combination. It's art and science. It is, VCs would say, oh, we'll look at the potential exit value, do a Black-Scholes model and figure out blah, blah, blah. Angels are looking really, really early stage. And so partly it's market. If I want to be investing in these deals and everybody else is investing in these deals, the only way I can get in is to invest at a 5 million valuation, and I want to play, I may be forced by the market to do that, even though I don't think the economics necessarily work. But if I want to be in it, you've got to play. On the other hand, if I look at at a deal and say, okay, what's the likely outcome? If the best this company can hope to sell for at the end of the day, 5, 6, 7, 8, 9, 10 years out, if everything goes absolutely right, if the best it can hope for is $100 million, right? And I'm getting, what can I get? I'll get $10 million. If I take the whole round at a 10 million pre, then I can back out and figure out what is it worth the time value money worth it to me over there. So typically it's a combination of comparables, market analysis, some rational assessment of where you can go at the end versus where you are now, and of all the other deals we see. So all the investors in this room, we're now pitching to you, but we see lots and lots of deals. To put things in perspective, many of you know that I'm the founder and CEO of a platform called Gust, which is the largest, it's the infrastructure platform that powers most of the early stage angel world. There are over 300,000 companies that have profiles on Gust right now. It's the largest database of startups in the world by a significant amount. And so we are adding something between 7,000 and 10,000 companies every month onto the platform. Think about that as deal flow. There is, so the question of all the opportunities we see, if you're over here and we've seen 6 other deals at the same quality deal, same quality stuff that are over here, you're likely not going to get funded at that. But anyway, there are like 5 different methods that are used, including a scorecard where we go through every aspect of the company and try and assign plus and minuses, and then relate that to the average market. There are ways of looking for major market questions and seeing where it's going. You can do Black-Scholes valuation backwards. So there are a whole bunch of them in the book, and you can figure out how we do it.
How do you, given sometimes with a long shot, it's 6, 7, 8 plus years, you often get solicited by larger funds to liquidity to kind of clean out early investors? How do you?
Oh, that'd be lovely. I mean, I tell you, angels would love to have. Danny, how many times you bought on angels? Yeah, right. Yeah, it doesn't happen. So as far as angels are concerned, invest with angels, yes. Tom, you've ever been bought up? How many times? once. It turns out that the early money stays in. Everybody's money ultimately stays in until you have a very happy exit for everybody. There are the once in a lifetime exceptions. We've each had one of them here and there, but they're really outside the ballpark. So typically, everybody's in. Your money's in, and it's illiquid until the very end game when everybody makes money or everybody loses it.
Related questions. Which is more confident successful outcome, to go straight to acquisition without going to institutional, or to go to a later round?
Well, there's a whole theory now these days called early exits, and this was promulgated by an angel investor in Canada named Basil Peters, who has written a book called Early Exits, which is actually a very good book, and has a website, early-exits.ca, if I recall. And the theory there is there are two different paths that you can take. And one path is, okay, we're going to invest as angels, put in a small amount of cash, and heavily help the company, and try and focus on getting that company acquired within 5 or 6 years, at a rational number. And that rational number of 20, 30, 40, 50, $60 million. And therefore, if we can invest our cash with no other cash diluting us over that period of time and get to an exit in that period, the IRRs work out, everybody's happy, we can take our money and invest again, and that should be the goal. So one of the masters of this is Ohio Tech Angels, which is a very professional angel group in Ohio. They got an IRR of 40% over a decade. And as they point out, they haven't had a single IPO coming out of Ohio in the last decade. But what they do is when they sit down and talk to an entrepreneur, they look her in the eye, and they say, okay, here's the goal. If in 5 years from now you can walk away with $5 million in your pocket, will that make you happy? And if the answer is no, I'm shooting for the unicorn, I'm shooting for the billion-dollar thing, then they say, we're not the right investors for you, right? Because our goal as an angel group, this is Ohio Tech Angel Fund, is to get you to an exit, that will put $5 million into your pocket within 5 years. And to do that, they then start out day one, the minute they invest in the company, trying to figure out what metrics are going to be appropriate for the acquirer. What is the acquirer going to buy you for? And let's focus on those metrics to get you all primed up and ready for an acquisition and help you do that. And so therefore, in that scenario, it makes a lot of sense to have no additional money, because additional money, when the VCs come in, all of a sudden, they're putting in a bigger chunk of cash, they're looking for a bigger home run, and it pushes out, and it makes the game higher. It raises the stakes, because then you have to have an exit for 100, 200 million bucks for it to make any kind of sense for their portfolio over here, and that typically takes a much longer period of time, and in some cases can be risky. So there are different ways to play it. Neither is right or wrong. They're just different. One question, and then we got to get off.
Curious, do you have any research on the difference between an active angel group, kind of a group that invests and then talks to the VCs and has a good ear to the ground of the CEO, versus a passive set of guys that just put in the money?
Yeah, in general, I think you will find that every investor in this room, now it may be self-serving, but every investor in this room will tell you to go for the smart money. And I can't reiterate that enough. There is just an inherent difference between smart money and dumb money. There are individual angels and there are funds who just write checks and say, hey, here's a check, I just want to be in the deal, take the money, and call me when you have an exit. If that money is coming in an angel world from people who are, doctors and dentists and not familiar with the domain that you're in and just writing a check, it sounds like easy money. It sounds like, oh, this is what I should really hope for because they give me the cash and run away and I get to run my company. But in reality, they are, a really good investor, whether it's an angel or a VC. Smart money can really add to the value of the company. So whether it's board service or introductions or customer introductions or follow-on venture introductions, important.
I'm just curious, because you said you've done over 100.
Yep.
I'm wondering how the transition from you having the CEO's ear the whole time, because you guys are the angel investors, versus the venture firm trying to come in and say, okay, why are you listening to him?
No, there is, if you have to ignore a lot of the stuff you read in the blogosphere and a lot of all of the chattering you hear from entrepreneurs and people who think they know what's going on. In the real world, this business is much more professional and much less cutthroat and much more logical and rational and practical than you might otherwise think. And so if you are dealing with smart angels and smart VCs, there's a lot of respect on both sides. As Denny says, they like to invest with angels. At New York Angels, I think virtually every deal that we have done in the last 5 years or so has been co-invested with either other groups or with venture funds. Probably a third of the deals that I've done have been invested with VCs, and things logically shake out. If it's a very early stage investment, then VCs are often very happy to have an angel who has maybe a little more time and can be more active in mentoring and guiding the company. On the other hand, when it gets to be a bigger later stage deals, angels say, hey, I can help you get started, but now these are the guys who have the ear of the M&A guy at Google or whatever, and do it. And so these tend to be very collegial things. I've been on boards where I was chairman of the board, and we did a VC round, and they came in, and then I left the board. It's more appropriate. I think this tends, if you get the right people, if you get real smart money, this all tends to work out really well. And so with that, I will thank you. Good luck and have a great afternoon.